So last week we introduced the course. There we discussed more about the scope of our course and how the Central Bank of Sri Lanka was originated, what made us to make the choice to establish the Central Bank of Sri Lanka, especially the weaknesses of the currency board, which is the previous system that we had before we introduced the central bank. And thereby we discuss how central bank address these weaknesses of the currency board, and also later we discuss what is the monetary policy, how central bank conducts the monetary policy, its tools, monetary policy transmission mechanism, and finally we briefly introduce the functions of the central bank. So today we are going to start session 2. There we are going to bit more explain on the central banking history, but not only the Sri Lankan context, but in the world. How the central bank was originated, how this concept was introduced in the history of the economies of the world. So thereby, after this session, you will get an understanding on the evolution of the central bank in various stages. Finally, it will help you to understand the background of how central bank rose to what they are today. Right? So this is the lecture outline. We are going to talk about the brief look at central banking history, historical role and functions of central bank, the international monetary system, and finally we are coming to the modern central banking. Now, prior to central banking, in the economy, I think you know the concept of barter system. That is, we are exchanging good for a good instead of the medium of exchange. There were no medium of exchange in the barter system. From the barter system, we introduced the money as a medium of exchange, right? So there's evolution of the money as well. So in the latter part, we used precious metal like gold, silver, sometimes copper as a medium of exchange or as a money, these precious metals. So these three inherent characteristics of this precious metal made it used to as money. So what are these characteristics? First one is it is accepted as a medium of exchange. It's a medium of exchange. Then it's a good store of value. So why we are saying it's a good store of value? Because these precious metals are not easily perishable. So we can store value using these precious metals. Then we say the third characteristics, unit of account. That means this precious metal can be divided into uniform pieces, so thereby representing the unit of account. So these three characteristics made precious metal as a mode of money to do the transactions. So these merchants use this precious metal to engage in the transaction in the market. So they purchase and they sell goods and services using the precious metal, right? Then, after the society developed a bit more, then this precious metal became more standardized and advanced, more formalized. So these precious metals were developed into coins. These coins were easier to transport and easier to recognize and classify. So these coins were stamped with seals and certified the weights and the values. So compared to the precious metals, coins were more formal and easy to use. Then the merchants started to use coins instead of precious metal as a medium of exchange to do the transactions. Then, but later, what happened? Even using these coins became difficult. Why? Because these coins were heavy and large. So these merchants had to store large number of coins and to carry these coins to wherever they go for the transactions. So it was inconvenient. Thereby, what happened, and also there is an issue, the later these different governments, or we say different sovereignties, they started to print different varieties of coins with different values and different metal content with them. So managing all these different type of coins became problematic. And also sometimes some people tried to make some extra revenue by same value coin but with a lighter metal content. Because I told you, different nations printed these coins with different metal content. So the same face value but different metal content. Then the people can make profits by acquiring or by paying using a less lighter metal content coins but with the same value. So we call it coin debasement. And another problem is with the usage, these coins may worn out. Then some of the time they found these clipped coins. Some people chip out the metal content from the coins and use those in the transaction. So this coin debasement, clipped coins, all these problems, due to all these problems, what happened in 1609, the Bank of Amsterdam was established in Netherlands. So the primary task of this Bank of Amsterdam was to sort and store coin. So from the precious metal here, using the precious metal, we switched to usage of coins. From the coins, it started to coin sorting and storing, right? So we are discussing the history step by step, how the central banking evolved, right? The evolution. Now in the second step, coin sorting and storing. So the primary task of this Bank of Amsterdam in Netherlands was to sort and store coin, right? So why especially the Amsterdam? Because that time Amsterdam was a premier global trading hub. That's why they chose Amsterdam. So these merchants, they deposited coins with the bank, and accordingly all this coin management thing was conducted by the Bank of Amsterdam. Then with the success story of the Bank of Amsterdam, in Sweden, the Bank of Stockholm was originated or established in 1656. So this Bank of Stockholm, they took the copper coins from the merchants, and sometimes they lending out these coins against the tangible assets. So the same as the Bank of Stockholm, they manage the coin sorting and storing. 5 years later, this Sweden government passed an act or decided to reduce the metal content of the coins, or to reduce the amount of copper in newly printed coins. So then what happened? Obviously, with the lesser metal content in the newly printed coins, those old printed coins became more valuable because they had more copper content with the coins, old coins. So people demanded more the old coins. So they demanded, or they started to withdraw their old coins from the bank. So then the Bank of Stockholm faced the threat of running out of the coins. Because now people want to withdraw their coins deposited with the bank due to this metal content problem. Then, to avoid this bank panic, to avoid the Bank of Stockholm from running out of the coins, what the bank did, they issued a credit note instead of coin. When the people want to withdraw their deposited coins, they issued the depositors a paper, we call it a credit note. So it has a fixed face value but no paid interest, and that paper was freely transferable from one holder to another. So these credit notes were called as creditive cedulars at that time. So these creditive cedulars were considered as the very first banknote in the history. So from coins, now we move to the banknotes. So this system was succeeded for almost 2 years, but finally the Bank of Stockholm failed due to the they failed to redeem the face value of the banknote. Then they failed. But anyway, in 1668, the new bank was established called Sverige Riksbank. So that is the central bank of Sweden. We call it Riksbank. So that bank was considered as the oldest central bank in the history. Even though the Bank of Stockholm failed, this system of using banknotes survived until up to modern economy. Right. So from coin sorting and storing, now we switch to the banknote issuance. Now you know the flow, how the central bank emerged. So what is the first central bank in the history, or the oldest central bank? That is the Riksbank in Sweden. But at that time, this issuance of banknote was not only confined to the banks that is established by the government, like central. Privately owned bank also can issue this banknote at that time. All right. So that is the history. Here you can see, this is the Bank of Amsterdam. And these are the coins that made out of precious metal. And here we have these creditive cedulars, or the very first banknote issued by the Bank of Stockholm. Now we come to the historical role and functions of central bank. Actually, during the last session also, we introduced this role. But today we are going to discuss these functions a bit more. The first one is banker to the government. So what is meant by this? Banker to the government. This function was there to help to finance the government spending, especially the wars. At that time, it was the wake of World War I, World War II. So there was huge financial needs by the government. So central bank had to help them to finance these huge war spendings. Because of that, the central bank had close relationship with the government. So then, not only the clearinghouse for the merchants, it became the clearinghouse for the government as well by financing the government spending. Sometimes this central bank issued bank notes even though they do not have enough precious metal to match the newly issued money. I told you always they issue money if they have reserves to back that currency. But sometimes with this close relationship with the government, they tend to issue more money even though they did not have enough reserves or gold stock to match the newly issued money, because general public had the trust on the central bank, as the central bank being the banker to the government as well. They know there was an implicit promise of the government to pay the note in the case of central bank fails to do so. All right, that is the first function, banker to government. Second one, banker to bank. So this is actually during the 19th century. During the 19th century, at that time, these bank notes issued by the central bank were widely accepted. General public trust and the confidence were there with the wider acceptance of the bank notes issued by the central bank. So then the commercial bank started to open accounts and place their deposits with the central bank, becoming the clients of the central bank. So central bank became key repository and clearinghouse for commercial banks as well. Why the commercial bank tends to keep deposits with the central bank? One reason is there was a close relationship with the government. And another one is there was a wide acceptance of bank notes issued by the central bank. And the monopoly to issue bank notes of the central bank made the commercial bank to become the clients of the central bank. So that is bank to bank. So it was bank to the government and bank to banks as well. Thirdly, lender of last resort. In other words, it means protector of the financial system. So last week also we discussed. Normally, what does a commercial bank do? They take funds from the excess units and transfer that to deficit units. So they borrow money from the excess units and they lend money to the deficit units. But there's a time mismatch between these borrowings and lendings. Normally they take or they borrow deposits from the public for a short-term maturity. But they lend those deposits to the deficit units as loans for long-term maturity. So their income source was long-term, but their expenditure was short-term. There's a mismatch. What happened in case of a adverse event happen, like maybe a war, maybe a bad harvest, or maybe a default by the borrower of the bank? In that case, if the depositors of this particular commercial bank lost the trust on that particular bank, they will immediately withdraw their deposits, right? It will create a financial panic. Then there might be a banking failure. So to avoid this banking failure, there should be some party to help out this distressed financial institution or commercial bank. So that party is the central bank. So why particularly the central bank? It can be someone else, maybe government, maybe treasury. Why central bank? Because central bank had very large reserves and it had extensive networks with correspondent banks, and also it had the monopoly over the banknote issuance and public confidence also with the central bank. So what are the reasons to select the central bank as the lender of last resort? It had large reserves, it had extensive networks with the correspondent banks, and it had the monopoly over the note issuance, and they had the public trust. But initially central bank was reluctant to be the lender of last resort. Why? Because at the origin of this central bank, they also consider themselves as a bank. Then that commercial banks were perceived as competitors of them. Because central bank think themselves as a bank, then the other commercial banks also are competitors. So they were reluctant initially to help out a distressed bank because they perceive it as a competitor. But later, in the latter half of the 19th century, it was initiated with the Bank of England. They started to be the lender of last resort by helping out the distressed financial institutions. But for that, they charge a higher interest rate compared to the market interest rate. And also, they help out the commercial banks only if they have sound collateral. So that is the lender of last resort. That means the protector of the financial system. Then the next function, bank supervisory. So here, actually this function emerged because of the previous function, lender of last resort. Being the lender of last resort, central bank has to help out the distressed financial institution or the commercial banks by lending out the money. Then it creates a risk on their own capital. They might incur losses if that commercial bank fails to survive, right? So, before acting as a lender of last resort, central bank had to know whether this particular commercial bank is credible or not. To observe that, central bank has to be familiar with that particular commercial bank. Before lending the money as the last resort option, in the case of bank in failure, central bank had to be familiar that bank was credible. How can the central bank know that particular bank is credible? There should be some way that central bank become familiar with the operations of the commercial banks. So there should be a prior assessment of the commercial bank's operation. For that, we have to have a formal authority for central bank to inspect the commercial bank's operations. That formal authority was given under the bank supervisory function. Clear? So because of the lender of last resort, there was a risk for their own capital of the central bank. That's why they have to supervise the commercial banks to priorly assess whether the operations are okay, whether the banks are credible. Normally, there can be two problems faced by these commercial banks: solvency problems and liquidity problems. Liquidity problems is where those are there can be a solution for the liquidity problems. That means the debts of that particular bank is lower than their capital and assets base. But solvency problem means their debts are higher than their assets and capital base. If that's the case, if that particular bank is facing a solvency problem, then central bank may risk its own capital by being the lender of last resort for that particular bank. Therefore, central bank had to clearly distinguish between solvency problem and liquidity problem. But it was not an easy task. For that, central bank should be having a proper understanding. So this proper understanding was given under the bank supervision. So that's how this bank supervision function was emerged as a historical function. But to conduct this bank supervisory function, central bank needed to be changed as a public institution. Why is that? If the central bank is also another bank or perceived as a competitor of the particular commercial bank, will the commercial bank allow central bank to access their confidential information? They might not. So in 1914, in the wake of World War I, finally, it was declared that central banks are public institutions who acted with a public interest, not a competitor for commercial banks, but a public institution works with the public interest. So that is the bank supervisory function. Even though we identify this function as a central bank function, some of the central banks did not take this bank supervisory function to their hands. Why? Sometimes they feel that supervisory functions might be interfere with their other goals and objectives to conduct the monetary policy. Therefore, some of the banks prefer to keep the supervisory function with a separate entity out of the central bank, separate institution. So actually this, before coming to the last function, we are going to the group activity. In this group activity, we will be discussing the debate on this bank supervisory action or the supervisory function of the central bank. I have uploaded a case study in the LMS. All right. So you can see the group activity. Here they have discussed about the debate on the function of the central bank as a bank supervisor. First, they argue that the central bank's the supervisory function should be not with the central bank. The first reason that they are pointing out is changes in the financial system, partly through the liberalization process that had begun in the late 1970s, which were blurring the lines between banks and other non-bank financial institutions. Here you have the explanation. For the first part explanation you find here. So they say with the development of the financial market, later not only the bank, non-bank financial institutions were also emerged to the market. Then this systematic stability, consumer protection, all these are covered under the supervision. So they argued for the central bank, they have the direct control on the banks. But Then what about the non-bank financial institutions? That's the argument that they brought here. And the second one is the fear that the bank supervisory function would be in conflict with the central bank's other growing function, that is, that of a conductor of monetary policy. Here the explanation you have here. There they say, now the central bank, if they conduct the supervisory function with them, if they have the control over the supervisory function, they have a proper understanding on the commercial bank's asset base. So they know whether the bank is going to fail in the coming few months, or if there are a liquidity problem with the bank, if there are a solvency threat for that particular bank. All these inside data were available for the central bank if they supervise the commercial banks, right? So in that case, suppose that central bank, considering the economic situation, they decided to increase the policy interest rate because they observe there is an inflationary pressure in the economy. So they have to a little bit conduct the contractionary monetary policy. So for that, they are going to use the policy interest rate as the policy tool. But since the central bank very well knows the monetary conditions or the financial condition of the commercial bank, central bank might think if they perceive that policy decision, maybe this particular commercial bank will fail for sure in the next month. It will become solvent. So that understanding is with the central bank. Therefore, they will become to hamper or to compromise their monetary policy goals with the on the view of the commercial banks. So to protect the commercial banks, they will hamper their conduct of monetary policy. So that's what the second argument they says. Because of this situation, they says the bank supervision should be with the other party. But in contrast, on the other hand, these are the reasons that they pointing out that the central bank should conduct the supervision. Very first thing they say is central bank, being the conductor of the monetary policy, they can access the micro level information from bank supervisors. So that means when they have the supervisory function, they can access to the information with the commercial banks. So the commercial banks have the access to the information with the micro level. Maybe one particular farmer, maybe one particular entrepreneur, maybe one particular another single party in the economy. So all these single micro agents are directly contacting with the commercial banks, not with the central bank. So if the central bank do have the supervisory function with them, they can access to that micro level data gathered by the commercial banks, and accordingly they can use that data to conduct the monetary policy as well. So having the supervisory function will be beneficial for them to understand the economic condition in a better way. So that's one argument. The second one is information sharing with regard to payment system and market and activities. So the central bank being the active party in the payment and settlement system where the commercial banks are engaging. So central bank have the information with the banks. But if the supervisory function is separately assigned for a separate entity, that entity do not have that information. So either they have to take those information from the central bank. And another argument they highlighted here is if there are many institutions for particular function, central bank being the conductor of the monetary policy and a separate institution for the supervision and commercial banks separately, there will be a coordination problem. So especially after 2000-2010 global financial crisis, they realized that the coordination failure was partly responsible for the financial crisis in 2010. So most of the banks, central banks, took the responsibility of the supervisory function again after this financial crisis. So they say uh, instead of having a separate entity, it is beneficial and it is rational for a central bank to have the supervisory function with them. So that's what this case study is about. All right. So within this group activity, you understood the both scenarios. Why we have to rationalize whether the central bank should implement the supervisory function or to give up the supervisory function. So you should be able to support the two statements. So again, going back to our session, now, so we are going to discuss about the international monetary system. Now we told you, if you can remember, central bank, the last function is the conducting monetary policy. So in that time, central bank got the wide reputation around the globe with the wide acceptance of the bank notes issued by them. So central bank had to sustain that trust of the general public. For that, they should be having a stronger financial status. So to increase the public's trust and to maintain the stronger financial status, they introduced a concept called gold standard. So in the gold standard, simple meaning of the gold standard is the currency should be convertible to gold at a fixed standard of gold. In other words, to issue extra money, always there should be extra gold reserve matched to that extra money printed. So that is the gold standard. So here, this gold standard, we say it is with the passive monetary policy. Under the gold standard, we can observe a passive monetary policy. Why we are saying it's a passive monetary policy? Because here, the main concern of the central bank is to issue money only according to the value of the gold they have. They do not consider, or they less concerned about the economic activities or economic variables of the economy that time. When they are issuing money, they did consider only about the available stock of gold. Because of the gold standard, they have to issue money which is matching to the available gold stock. So that was their primary concern. So at that time, they did not understand that there is a huge direct impact from the money to the economic variables. From altering the money supply, they can influence the economic variable, but because of the gold standard, they did not have the capacity to directly influence the economic variables or to stimulate the economy using the monetary policy because of the limitation of gold standard. So their key concern was to keep value of money fixed to gold at the announced level. But with the World War I, this gold standard was disregarded. Why? Because of the excessive war expenses, the government had a huge, government is with a need of huge financing. To support the government with financing of the war expenses, central bank had to print money excessively. So to print that money, there is no enough gold to match that printed money. With that, the gold standard was disregarded because they couldn't continue the gold standard due to the higher expenses of the war. Then they came to the gold exchange standard. So what is meant by gold exchange standard? There what they did, major countries pegged their currency to gold. So the bigger countries peg their currency to gold, where the smaller countries use the currencies of these major countries to back their own domestic currency. So you will be confusing. So I will use the whiteboard to elaborate more. Let's suppose that there are two countries, country A, country B. So the country A is the bigger country. Okay. Then the country B is the smaller country. Now country A has its currency. This is country A's currency. And here we have country B's currency. This is country B's currency. Alright. So now under the gold exchange standard, country A back or peg their currency, this is A's currency, with the gold reserves. So they back their currency with gold. So they back their currency with gold. All right, so they back their currency with gold. But here country B, being the small economy, they back their currency or peg their currency to the currency of A, not gold. So they back their currency to A's currency. So that's what the simply gold exchange stands to. Here, this is A's currency. This is A's currency. Clear? Here, country A being the large economy, B being the small economy. This is A's currency. So now A pegged their domestic currency to gold. B being the small economy, it pegged their currency to A's currency, not gold. Then with that gold exchange system, so a large number of gold reserves were not needed. All right. Then from the gold exchange standard, it stepped towards to the Bretton Woods system. Why the Bretton Woods system? Here, this is the era where the John Maynard Keynes, the famous economist, and his views emerged to the economy. So he found that activist monetary policy can influence the economic variables in the economy. That means they identify monetary policy can influence the economic variables directly. So we call it activist monetary policy. So here under the gold standard or gold exchange standard, we had a passive monetary policy. Why? There we only concerned about the availability of the gold reserves to issue money, not on the economic variables or to stimulate the economy. But under the Bretton Woods system, we conduct an activist monetary policy. So it replaced this gold standard. There, what happened was United States of America pegged their currency to gold. So US being the large economy, pegged their currency to gold. Particularly, their standard was 35 US dollars to 1 ounce of gold. Then all other countries peg their currency to US dollar. So US is the only country who maintained the gold reserves. All other countries peg their currency to US dollar. Somewhat similar to gold exchange standard. Only difference is the only country is USA here. Only large economy is USA. All other economies peg their currencies to USA dollars. So it was somewhat like a global fixed exchange rate system where they follow one particular rate. All right. So even though activist monetary policy was conducted under the Bretton Woods system, later US was suffered from a very hyperinflation situation. That happened because of the higher war expenditure and also the government spending. So because of the activist monetary policy and the higher fiscal spending, US faced an inflationary situation. Because of the inflation in the US, the purchasing power of the US dollar reduced. Then all other countries who peg their currency to US dollar question the link between the US dollar and the gold, because US kept issuing money to maintain their economy because of the hyperinflation. Then the trust on the Bretton Woods system or the confidence on the US dollar collapsed. Then all other economies started to liberalize after World War II and allowed their currency to freely float. So that was the collapse of the Bretton Woods system. Okay, now you know how we are moving from the gold standard to the Bretton Woods system. Then, after the experience of the US with inflation, they identified, rather than the benefits of the activist monetary policy, they faced more harm to the economy. Because of having the activist monetary policy directly influencing the economic variables, they ended up with hyperinflation. Therefore, they decided there should be explicit rule to control the money supply in the economy. So that explicit rule was introduced under the money supply growth targeting. So this money supply growth targeting was introduced to control the inflation and to provide an explicit rule or direction to control the growth in the money supply. In that time, central bank needed to have the operational independence. Why? In Sri Lanka also, recently we experienced some of the fiscal policy and monetary policy conflicts, some arguments, some repercussions. But here, most of the time, the central bank face influences by the government. Sometimes these politicians, with their short-sighted visions or goals, they influence or they affect the central bankers to stimulate the economy. For an example, if they want to win the upcoming election, they might influence the central bank to ease the monetary condition and provide more money available in the economy that might make people happy. But that is a short-sighted or short-term objective. They do not consider about the long-term effect on that decision. In the long term, it will result in inflation. But these short-sighted politicians do not consider that. That's the problem. So with the money supply growth targeting, central bank wanted to have operational independence, which is free from the fiscal pressure. then they should be able to tighten the monetary policy with an explicit money supply. There should be a target rule. Then they can avoid overprinting money. So that's the start of that's how the monetary supply growth targeting was started. But later, this regime also abandoned because of the uh, unstable relationship between money and the real economic variables. Even though we say when the money supply increases, inflation increases, with the advancement in the economy, with some financial innovation, later it became more complex to identify the relationship between money and inflation, money and other economic variables. So, what they did, they abandoned the money supply growth targeting and they switched to the inflation targeting. So, actually, this inflation targeting was introduced in New Zealand in 1989. Under the inflation targeting, there were primarily three conditions to be filled. The first one, announced numerical inflation target over a time horizon. There should be a numerical inflation target announced. The second one, implementation of monetary policy that aims to keep inflation forecasts within the target over the time horizon. Then the thirdly, higher degree of transparency and accountability. So why we are saying that inflation targeting is a transparent and accountable framework? Because the inflation target is announced, publicly announced. So the people know, the general public know that the central bank aims to keep the inflation rate at this level, right? And the transparency is that. Accountability means if the central bank did not able to meet that announced target, then they have to give the reasons to the general public and other officials. They have to justify why they would not be able to achieve that inflation target. So that is why we say inflation targeting is transparent and accountable. So they use the policy interest rate as a tool to affect the cost of borrowing, thereby affect the economic activities to control the inflation. So that's how we step from the money supply growth targeting to the inflation targeting. Then one benchmark in the central bank history is the creation of euro. This is a common currency, a notable milestone in the central bank. Why? 11 founding members in 2000 in the European Union formed this European currency called euro, the common currency, and a common central bank for the union called European Central Bank. So it's a notable milestone in the central bank history. Then finally, the commonalities and the diversities. What are the similarities and the differences between the modern central banking? What are the similarities? The monetary stability, financial stability, and no direct lending to government. So this monetary stability and financial stability are main goals most commonly adopted by many central banks in the world. So they have set the monetary stability and financial stability as primary goals. Why is that? The last week also we discussed monetary stability or price stability is a crucial precondition for an inclusive growth in the economy. Where the prices are low and stable, investment and consumption decisions can be optimized. That means we can directly stimulate the economy but without hampering the price stability or the monetary stability. So this was a key goal adopted by many central banks, similar feature. Financial stability. There again, financial stability means the financial system should be able to absorb external and internal shocks. So it should be sustained or resilient to the shocks. So this lender of last resort function, bank supervision function, enables central bank to conduct this or control this financial stability. Similarly, maintaining financial stability has commonly accepted by many central banks as a primary goal. Then no direct lending to government. Why is that? Because they later identified if they directly lend money to the government, it will cause hyperinflation later. So when they print money, then they will lend that money to the government, it will cause the government expenditure to increase, thereby boosting the aggregate demand and then the increase in prices and finally the hyperinflation. So most of the time, all the central bank in the world avoid from direct lending to the government because it might has bad adverse impact to the economy. Then the differences. These are similarities. Then these are differences. Approaches to monetary stability. That means even though all the central bank wants to control the monetary stability or to maintain the monetary stability, the approaches or the methods that they use to achieve this might be different from central bank to central bank. Some might adopt inflation targeting framework. Other central bank may go forward with monetary targeting. Some might take exchange rate targeting. So these monetary policy regimes can be different from central bank to central bank. But the goal is same. So that's one differences approach. Then the second one, institutional setup for financial stability. What is meant by that? So that means, like we discussed before, maybe some of the central banks will assign the supervisory function for a separate entity. Maybe some other central banks keep the supervisory function within them. So that institutional setup can be changed, but maintaining financial stability is common for all the central banks. Then third one, explicit role towards full employment. So this full employment is much controversial mandate or a goal of a central bank that we will be discussing in later sessions as well, because this full employment means very low unemployment. We know there's a negative relationship between unemployment and inflation. If we want to reduce the unemployment to achieve the full employment, then it might cause an inflationary pressure in the economy. So always there's a trade-off between inflation and employment. Actually, this is second year macroeconomics content. So then the decision of the central banks towards the compromise between the inflation and the unemployment may be changed. Some of the central bank may give the priority to the employment depending on the economic situation. Some may compromise employment in terms of maintaining low inflation. So these are the differences. So that's all for today's sessions. So today basically we discuss how the central banking history happened in the economy, how the world created this concept of central bank, and we elaborate more on the historical roles and the functions of central bank, and then we discuss about on different concepts like gold standard, gold exchange standard, Bretton Woods system likewise. And finally, we discuss the similarities and the differences of the modern central banking. So let's meet at the same time next Tuesday. Thank you.